For a look at the big picture and perhaps to answer some of the questions that I've just posed to Richard and Richard and Todd and some of the questions that they've been debating there on the river. I'm joined by Bob Hormats, Vice Chairman of Goldman Sachs International in New York, and Eric Weiner, author of What Goes Up, A History of Wall Street. He joins us from the New York State Capitol, Albany. Guys, thanks for joining us. I hope you heard that debate going on there in the miserable weather of this Friday afternoon, but a heated debate there, and ultimately talking about, you know, this credit crunch and the influence of these huge private equity funds that have been dabbling, let's say, for want of a better word, in these markets. Just who is running our money, or at this point, you know, where do we go?
Well, I think we go now to a period of rather prolonged volatility. I don't know how much the market's going to go down, but I know it's going to take time for it to settle down at this point, because a lot of the money that was so easily available for these deals is not going to be so easily available for these deals in the future. That's going to be one note of caution, which is going to keep the market down. The other, of course, is, does this event, which is primarily now a Wall Street event, become a mainstream event? To what degree does this lead the average consumer to become more cautious when they see their 401k, their retirement plan, go down? And then, of course, you have the housing issue, which is sort of an underlying factor, the subprime market. All these things are notes of caution, not notes of desperation, I would add, but notes of caution and uncertainty for the next several weeks and perhaps more.
All right, Bob. Eric, I want to bring you in here. I mean, I'm wondering whether we should be surprised by this volatility, given the run that these markets have had. And a question to you, for our viewers watching tonight, how does the retail investor cope with what is going on at present? Because we all know at the end of the day, it's our money that's being invested, but it's ultimately the big guys who are moving these markets around, and we get left behind, don't we?
Well, we absolutely do, to a sense. Really, if you're a retail investor, I think you kind of want to turn off your television set right now and sort of wait and see how this all shakes out, because volatility means up and down, and if you're a retail investor and you're in this to try and capitalize on the up and down, Bob Hormats over at Goldman Sachs can tell you you're probably going to lose. I think when you look at this from the big picture, what you're really seeing is the history of the stock market playing out, and that is this idea that we go through these periods of bubbles. We've seen enough of them to know exactly what happens. This is something that I covered pretty extensively, actually, in What Goes Up. The idea that we go through these exciting periods and then they get ugly, and so what you're seeing right now is a bit of people heading for the exits.
Bob, I've got a sense of deja vu. I've been around long enough, unfortunately, to have seen these movements, let's call them, in the markets, you know, 2 or 3 times. Is this what is known as the 7-year itch?
Well, I don't know if it's a 7-year itch, but it certainly does occur, as Eric has very accurately pointed out, on a fairly regular basis when the markets get a full head of steam, particularly when risk tends to be underpriced. In other words, people do not really have a strong perception of risk in the way they price their investments, either by buying houses or taking out mortgages for houses or buying stock. Then it ultimately experiences a tumbling, which we're seeing now. And then the market finds a level of stability. It can happen sooner, it can happen later. It's hard to predict. There's a lot of uncertainty about who holds this debt and what the knock-on implications of this debt are going to be, but it will stabilize over a period of time. Eric's right, it's part of a cycle. Boom, bust, or substantial increases and substantial decreases, whatever one wants to call it. And he's absolutely the retail investor at this point. If you try to start playing it and timing it, it's very difficult to do. If you're nervous about it, you do have the opportunity to sell and wait it out. But if your timing is right, you can do fine. If your timing is wrong, you won't. Okay. So it's very hard to time the market.
Eric, what are your biggest concerns going forward? I mean, we really look at the sort of, you know, at the technicals here, and I don't, you know, I hate to do this on what is, you know, sort of a normal news channel, but we've done it before and we'll do it again. You know, should we be looking at these sort of technical analysis at this point, and what are your biggest concerns?
Well, I think, Becky, when you look at it, you really need to look, actually, if you're going to get technical, at the debt markets, because that's really what this is being pushed along by. what built up the bubble was the idea that we could all borrow money very cheaply, whether it was housing, whether it was credit cards, and then whether it was actually buying a company for like $20 billion. But the point is that when you have this easy access to cash, then that builds up the market. The equity markets, the stock market, is responding to that easy access to cash. So if you really are concerned and you want to get technical and watch something, see what happens in the debt markets. If they tighten and then there isn't that easy access to cash, the rest of the house of cards is likely to come down. But it's not until you see that happening in the debt markets that you really need to panic.
Interesting stuff. Bob Hormats and Eric Weiner, we thank you both very much indeed for joining us tonight. You're watching Business International here on CNN. Coming up.